In this video, I'd like to explain to you what depreciation is, and also a little bit about how to record it. This is a series of videos. There is an initial video on property, plant, and equipment, and there's a video after this on how to calculate depreciation. So this is just an introduction to what depreciation is. And what is depreciation? It allocates the cost of property, plant, and equipment to the periods when it is used. And this is a little confusing to people because people usually associate depreciation with a decrease in value. And in English, depreciation means that it is decreasing in value. In accounting, the definition is slightly different. In accounting, the definition is this, that it allocates the cost of PP&E to the periods when it is used. And property, plant, and equipment, again, are assets that have physical substance used in your business. So how does this work exactly? Let's say you buy a truck that costs $10,000 and you plan to use it for 5 years. Then the depreciation each year would be $2,000. In other words, depreciation is how much the truck is costing you for the period of time that you're using it. And so that's a slightly different definition from what you may have started thinking when you started watching this. And it's also, I want to note here that in order to calculate depreciation, you need to estimate the useful life of the asset. You need to try to predict how long you plan to use it. And that may sound difficult, but in reality, people usually have that thought in the edge of their mind. When I bought this computer, I was thinking, I'm probably going to use this computer 2.5 to 3 years. So there are various different methods of depreciation, and again, you'll have to watch the next video to see how you do depreciation. The first is called straight line, where you take the cost of the property, plant, and equipment, and you divide by the number of periods used. And there are 3 other methods. One is called double declining balance, another is called sum of years digits, and another is called MACRS. Modified Accelerated Cost Recovery System. And every U.S. company must use MACRS on its tax return. And that's IRS regulations. So how is depreciation reported in the financial statements? In the balance sheet, you would report something called accumulated depreciation. And this would be the total depreciation recorded over the life of all of your PP&E up until now. So every year you record depreciation, accumulated depreciation is going to increase. And the way this is reported on the balance sheet is that it's subtracted against total property, plant, and equipment. So on your balance sheet, you would have total property, plant, and equipment. You would subtract accumulated depreciation in order to get what would be called net property, plant, and equipment. And accumulated depreciation has the distinction of being something called a contra asset. In other words, a negative asset. In the debit-credit system, it has a credit balance because assets have debit balances. And this is a negative asset, so therefore it's the opposite of an asset, you could say. And therefore it's going to have a credit balance. On the income statement, you're going to report depreciation expense. And this is the amount of depreciation that was recorded during the period. And again, there's another video on how to calculate depreciation. Look for that video. Depreciation on manufacturing equipment, on the other hand, there's a slight exception to this, and that is before inventory is sold, depreciation on manufacturing equipment needs to be allocated to inventory until the inventory is sold. So if you're using the machine to make things, the depreciation cost becomes part of the cost of the things that you're making. And then when you sell the inventory, it becomes part of cost of goods sold. The journal entry to record depreciation is very easy to remember. Debit depreciation expense, credit accumulated depreciation. So remember that truck cost $10,000, 5-year life, $2,000 a year. So each year you would debit depreciation expense and you would credit accumulated depreciation. Depreciation expense is an expense, so debiting it is going to increase that expense, and it's going to decrease net income. Accumulated depreciation is something called a contra asset. It's a negative asset, and therefore crediting accumulated depreciation will increase accumulated depreciation, but it will decrease total assets because it's going to offset your assets. Now, if you sell an asset, let's suppose that after a year of having this truck, we sell the truck for $9,500. So again, remember, this truck originally cost $10,000. It was depreciated for 1 year for $2,000. And now we're going to sell it for $9,500. The journal entry would be to credit property, plant, and equipment, shown here, for $10,000. And debit the amount of accumulated depreciation that you've recorded for that equipment. In this case, it would be $2,000. Then you're going to debit cash for the amount of money that you received, $9,500. And the difference between these is going to be the gain on sale, in this case, $1,500. Another way to calculate the gain is shown right here. $9,500 minus the costs, minus the book value rather, of $8,000 gives you a gain of $1,500. The T account for accumulated depreciation, your beginning balance. Remember, accumulated depreciation has a native credit balance. So the beginning balance, the balance of accumulated depreciation at the beginning of the year, this would be the same as the ending balance of accumulated depreciation at the end of the last year, because it's carried forward from one year to the next. So you'd start the year with your beginning balance, whatever it is, which was whatever you had at the end of last year. You would add any new depreciation. You would subtract any disposals or sales, as we did in the previous journal entry right here. We debited accumulated depreciation. And then your ending balance would be all the credits minus whatever debits that you have. And one more thing to know here is amortization. Intangible assets, I've talked about this in the PP&E video, are things like patents and trademarks. This is long-term assets that you own and use in your business, but they don't have any physical substance. And these are never depreciated, but rather they're amortized. So they would have amortization expense instead of depreciation expense. And a little tip here about financial analysis. Financial analysts tend to ignore depreciation expense. They like to use a measure called EBITDA, earnings before interest, taxes, depreciation, and amortization. And they don't look at depreciation expense. And the truth is that because depreciation expense is not paid for, it's simply a paper entry, then maybe there's a good reason to ignore it. You can't ignore it when you're preparing financial statements and when you're doing accounting, because generally accepted accounting principles require it. And depreciation will give you a deduction on your taxes, so you certainly don't want to lose any deductions on your taxes. But if accumulated depreciation is very high on the balance sheet in comparison to total PP&E, then that may indicate to you that the company's assets are old and they're not as efficient as they used to be, or perhaps they need replacement soon, and that's going to cost the company money. Large depreciation expense could indicate that the company has too much PP&E, or that it paid too much money for its PP&E. So those are just some tips. If you like this video, please hit like below. And if you'd like to watch how to calculate depreciation, then look for that video down below also.